Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Okay, so there is a lot going on here in a relatively short amount of time. The top side has been dominated in recent days, despite a brief breach higher 2 weeks ago, by the combination of the flatlining gold long moving average, currently 566 and a quarter, and the flat dark blue trend line, currently 570 and a quarter, which I will deal with shortly. I said 3 weeks ago, and I quote, "Please bear in mind that beyond these we have some clear air up until the congestion at 588 and the March 2021 low at 592, end of quote. As we saw 2 weeks ago with that breach, a sharp run up, then capped by the congestion at 588 and the March 21 low, and the equally sharp drop later. I also added 2 weeks ago, and I quote, "A new pattern has emerged and seems to be taking over the running of this market. It is not a great looking pattern, but it nevertheless still there, and it seems to be dominating the action. It is the mid-March to late June reverse head and shoulders pattern, with that previously mentioned flat-lining dark blue neckline. Now there's a lot going on in this pattern, but I would draw your attention to one feature, and that is the mid-May to early June double top pattern. Well, it failed, and it should now be considered not only as part of the second shoulder, but also as a possible halfway hesitation pattern." Now, and that's the end of the quote. Now, I also spoke of this possible pattern during the prior week, so 3 weeks ago, and there were some elements there that I think you should still consider, and I quote, "It is to look at the whole mid-March to date action as a possible reverse head and shoulder pattern. Typically, this is seen as a bullish reversal pattern, but head and shoulders continuation patterns of this also exist. So delay any opinion on which one until I have some further data. The neckline for this, well, I'd use the crucial gold long moving average right now until we see further developments," end of quote. As you can see, I finessed the gold neckline to a separate solid neckline, and I did have two weeks ago enough of a move higher, admittedly through some empty space to lay out some potential topside target's topside. Thus, a primary target X would be in the 616 area, whilst a secondary harder to reach target X1 would be in the 635 area. I finally added 2 weeks ago, and I quote, "I'll now watch and see if the pattern performs as a reverse head and shoulders pattern or not," end of quote. Well, this head and shoulders pattern as a bullish reversal has not performed well, as we've had a drop last week and this week. Well, we've seen a recovery, but not much of one, as that same old gold long moving average and the dark blue neckline overhead have capped prices again. However, we did see once again, the impact the purple neckline extension, currently at 535, had on the market once again as a support. All this being said, I will for now still keep targets X and X1 topside still on my daily chart, but I've been looking at something else that might show a different point of view to this market, and this is where the so far unhighlighted mid-February to mid-June bearish Andrews picture comes in. It is early yet on this one, but it might prove to be a better view of what is happening here than the reverse head and shoulders idea. For this pattern, we are right now in between the overhead upper time, currently at 584, and the middle time below, currently 527. Now just keep an eye on this one, it might just be useful. Chicago corn. 5 weeks ago I drew a mid-February to mid-April bearish Andrews picture, which, whilst not being exact, showed for quite a while the bearish angle of attack of this market, especially the upper time. However, the upper time had been breached on a number of occasions, and 4 weeks ago finally broken. Now, I've still kept this broken pitchfork on my daily chart for a reason, which I will now explain. I originally chose the steeper bearish Andrews pitchfork over the shallower bearish shift pitchfork for the same move, as I thought it gave a more suitable representation on the way the market was moving lower, which it did. However, and it is an important however, and I quote from 3 weeks ago when I said, However, that being said, the time's next crossover this coming Monday the 19th of May, so watch out for one or more of the following then. A change in trend, a reinforcement of a trend, volatility. Coincidentally, after changeover this week, prices are now testing the 50% absolute Fibonacci line at 425. So it's worth being cautious right now. End of quote. The caution back then was well rewarded, as on Monday the 19th we had a combined key reversal up, if only just, plus a bullish engulfing pattern and a bullish opening white Mariposa, leading to prices rising up in the early part of the week 6 weeks ago, filling in the changeover gap and thus fully justifying the earlier crossover warning I'd given. 4 weeks ago, with the break over the upper tie, I finally drew the shallower bearish shift pitch hawk on the daily chart for the same move as the bearish Andrews one, as the market transitioned from the steeper Andrews to the shallower shift pitch hawk. Thus right now we're in between the overhead middle time, currently 430, and the lower time below, currently 394.25 of the bearish shift pitch hawk. Now, before I review the very recent market action, there is a significant event I would now like to discuss, and the one I highlighted 2 weeks ago and again last week at a biofuels conference I was speaking at in Brussels, Belgium. And I quote, "This ties in with the earlier crossover of times back on the 19th of May. You see, the next crossover, indeed the last and possibly the least powerful crossover, will happen on the 24th of June. I've highlighted it with a bright red circle just above this picture of me on the screen. Be wary then, just in case we see a possible change in trend or a reinforcement of a trend, and of course volatility, or even all three of these all at the same time. So caution." End of quote. Well, as you can see by the action of on the 24th of June last week, we had a break lower to new lows not seen since September last year. And it was only congestion at 403 plus the just below November 2020 low at 397 and the lower time of the bearish shift pitch hawk that halted and turned prices back up, thus fulfilling what I cautioned about so many weeks ago about that day. Our recovery has not been an easy one, as prices were capped yesterday, thus stopping a possible weekly key reversal by the overhead and immediate 50% absolute Fibonacci line at 425, which in turn created a shooting star pattern yesterday, typically a bearish pattern, though there is a bullish variety, so we'll have to see next week's action to confirm. We also have nearby the December 2020 low at 414, which ties in with the low of late November last year. Support is then fairly evenly spaced out at 409, 403 until the November 2020 low at 397. And that is just about as far as I'd like to go right now before I once more review the market action. Obviously, should we manage to break down that far, in the meantime, I would suggest paying close attention to the overhead 50% absolute Fibonacci line and to the middle and lower time of the bearish shift pitch hawk going forward. Kansas City wheat. Since mid-February, two major patterns have developed here, one of which is still alive and a third that is no longer operational, but from which we have some echoes that resonate even today. The first pattern is a mid-February to late April sideways triangle. It's not a great looking pattern by any means, but it nevertheless still existed, and 10 weeks ago prices pushed down below the lower trend line, whilst at the same time following on lower from a mid-March to early May bearish halfway hesitation pattern. The second pattern is a dark blue February to March bearish shift pitch hawk. This pattern is also not a great looking one, having both the lower time, currently at 481, and the upper time, currently 576, pierced, breached if you will, but not broken, and both times continue to play a role, a more significant role these days, in showing the bearish angle of attack. Interestingly, in recent weeks a new pattern has started to emerge, though this has also been breached, whilst at the same time some older resistances, and I suppose supports as well, have influenced the market. The older resistances, well, they consist of the combination of the bright green lower trend line extension, currently at 464 3/4, of the November 23 to April 24 descending triangle, plus the declining mauve medium moving average, currently for 564, and the gold long moving average, currently 571. These did not stop the market's rise, but they sure eroded the move higher, enough for prices to turn lower 2 weeks ago. At the same time, the support of the 38.2% absolute Fibonacci line at 532 and the low of the August 24 at 527, which was in turn created by that 38.2% absolute Fibonacci line, managed to hold up prices over June. Excuse me. We also had the development of another pattern, one that started out as one thing and developed into something else. You see, I said 2 weeks ago, and I quote, "The short purple upper trend line, currently at 570, of the interesting mid-May to date bullish halfway hesitation. This pattern is interesting, as it started as a possible double top pattern, a quite good looking one, pattern that then became a small expanding wedge pattern. That was part of what is a larger bullish halfway hesitation," end of quote. This original double top that became a small breach but a repaired expanding wedge pattern with aspirations to be a bullish halfway hesitation, in the end failed to live up to the promise of the bullish halfway hesitation, and instead has seemingly reverted to a breached and now repaired small expanding wedge pattern, and that's currently 526 to 570. I would suggest that this, along with the dark blue bearish shift pitch are the patterns to watch for the immediate future, despite their battered conditions. There is one other factor to bear in mind, and it's an old one, and something I spoke about most recently 2 weeks ago, and I quote, "There's one other thing to consider, and I have not highlighted it on my daily chart, but it's becoming increasingly significant. 7 weeks ago, so that is now 9 weeks ago, prices broke down through the lower time, which is currently at 552.5, of the significant, if very shallow, late August to early December 24 bullish shift pitch rule, the one that I was considering retiring. I've kept it on as these past few weeks, prices have moved back over the broken lower time once more," end of quote. Well, since then we have dipped once more below the broken lower time, but then moved up towards it once again. I'd keep an eye on this one, as I am wondering if this pattern, this broken lower time of this pattern, is becoming something of an attractor for the market right now. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.